Good afternoon, everyone. Welcome to this week's edition of Getting In, a College Coach Conversation. My name is Ian Fisher, and I am sitting in as the host of the show today. We're looking back at early July today when we had a couple of big items in the news that were centered on SCOTUS decisions, in particular with affirmative action in college admission and also with federal loan repayment. So a little bit of an update on where things are and what families should be thinking about with respect to those two outcomes. We want to start with the finance piece. And in order to do that, we're going to bring in Michelle Clifton, who has been the star of our team, of our finance team over the last couple of months in terms of bringing all this information together and gathering news and making sense of basically a landscape that doesn't make a whole lot of sense. Michelle, thank you for doing that. And thank you for being here today.
What an intro. Thank you. I'm happy to be
Thank
here.
you. Seriously, like this stuff is super complicated. And I hope you can just give us a little bit of an update on how we got here, right? So there was a potential loan debt forgiveness plan from the Biden administration. My understanding is that's off now. What's going on? Where are we?
Yeah. So I'll back up a little bit. So back in, it feels like forever ago, August of 2022, I remember that day vividly when President Biden announced the one-time debt relief for up to $10,000 for some borrowers, $20,000 for Pell Grant recipients, for federal student loans. There was so much excitement over that. And then I can't even remember how long later, there were a variety of different lawsuits in regards to that. And it ended up going to, a few of them went to the Supreme Court. And we waited and waited for the Supreme Court decision, and it finally came out on the last day of the session, of course, on June 30th, that morning. I will remember that morning vividly as well. So they ended up blocking the debt relief. And that afternoon, President Biden announced that they were going to try again instead of doing the HEROES Act, they were going to try to do it through the Higher Education Act, which has a whole nother process in itself. And they have to go through negotiated rulemaking, and it takes a long time. Like, just for an example, he also announced the new income-driven plan that afternoon, which is called the SAVE plan, which I'm sure we'll end up talking about as well. But that process started in the fall of 2021. And then that went through negotiated rulemaking, and then that was finally announced. The proposal was announced this past January, and then that was finally announced on June 30th. So this process takes a while. So we really don't know at this point. And even if it does go through successfully, it may have its own legal challenges. So my, kind of advice to borrowers is to not hold your breath for it, but also, if it does come through, that would be wonderful.
I think holding your breath in this economy, in this world, is probably just a bad idea. Please breathe deeply all the time, whether it's related to student loans or anything else. Now, because of the legal challenge, because of the SCOTUS decision, for many borrowers, loan repayment is starting.
Yeah. And actually, funny enough, it's not starting because of that, which I forgot to mention. So the debt ceiling bill actually prohibited the extension of the loan pause. So I would imagine that since they're trying to do this through the Higher Education Act, they may have tried to extend the loan pause again, but they can't because of the debt ceiling bill. So because of that, interest has already started to accrue. So the loan pause officially, after 3.5 years, the loan pause officially ended on September 1st. So interest has started to accrue on September 1st. And monthly payments are resuming in October. Now, that doesn't necessarily mean October 1st. I actually just talked to someone yesterday who had an October 1st deadline. It's the first one I've had. Most people are all over the place in October. And some borrowers haven't even seen their due date yet because the servicers aren't completely up to date in getting that information populated on the websites. So some people are panicking a little bit, but I would tell them to take a step back and just wait, because the servicers do have to bill them 21 days prior to the deadline. So it will be coming if it hasn't already.
But if you haven't seen it and you get it, you do have 21 days between when you receive that notice and when you actually need to make a payment.
Exactly. Yep.
Okay. This might be outside of your scope of expertise. I want to try it anyway. There's some mutterings about a potential shutdown and some budget negotiations. Will that in any way affect the return to repayment, given that part of the conflict is around that debt ceiling deal?
I don't know. Yeah, I don't want to assume anything on that. I'm not
Okay.
sure.
This show
Yeah.
comes out in a week, so let's not say anything. Maybe by then the question will be moot.
Whatever I
Let's
say will be the opposite anyway. So
let's stick in the area that we know, which is college finance and college admission. So let's say we've got a borrower who's starting to look at the stakes and understanding that repayment is starting, and they're looking at those interest rates as well. What about changing a repayment plan? Is that something that folks might want to consider? And what are the reasons to consider that?
yeah, that's a good question. And it's actually something that I find borrowers don't, they often don't know that they can change their repayment plan at any time. And in most cases, you can change it at any time. So if say you have someone who has never been in repayment, whether they were a 2020 graduate or a more recent graduate,
Mm-hmm.
past 3 years of recent graduates have not been in repayment yet. If you're in that circumstance, the servicer is going to automatically put you into the standard 10-year repayment plan, but that's not the only option. There's a graduated plan that's also over 10 years that starts out a little bit lower, increases
Mm-hmm.
every 2 years. If you have 30,000 or more in debt through federal loans, you can use the extended repayment plan up to 25 years or the graduated extended up to 25 years, which similarly starts out lower, increases every 2 years. So those are a couple of the more kind of standard options. And
Okay.
then there's also a variety of income-driven repayment plans, which most notably the SAVE plan that was recently announced, because that one is a little more generous than the prior plans as far as giving borrowers a lower monthly payment. So they the ones I just talked about before, in order to choose one of those, you would just go to your servicer's website and select one of those plans. But if you're wanting to use an income-driven repayment plan, the best way to start that process is to go directly to studentaid.gov/IDR, and it's going to take you through an application that actually doesn't take too long. I've helped many people do it in recent weeks, and it's very quick. It basically, they've changed it where before you had to use the old IRS data retrieval tool, like on the
Mm-hmm.
FAFSA, to pull over your
Mm-hmm.
tax information. Now it's just a basic consent where it's a little kind of a little scarier, where you basically just say, I consent to have the Department of Education access my IRS information. And you don't have to do it that way if you're not comfortable with that, but you'd have to follow up with documentation if that was the case. But if you provide consent, they will get your most recent adjusted gross income. They will calculate the different plans for you right there and tell you what your monthly payments are based on your family size and your income.
Wow. Wow.
But then the problem is,
Got to
after
be a
this
problem.
point, yeah, it's taking, and we're finding some servicers are taking longer than others, from when this process gets submitted to when that payment gets updated on the servicer's website can
Ah,
be, and they say it right on the application, it can take up to 4 weeks. We've had a couple of people that have been waiting for like 6 weeks. So the problem is the payment amount isn't updated on the servicer's site, so they can't make the payment that they're expecting to pay. But I noticed that they did add an option at the end of the application where you can opt, because we're getting so close to the first monthly payment for October, you can opt to do a 1 month forbearance, and they kind of force you into it. I don't really love the way they do it, but they force you into a 1 month forbearance where you select an amount to pay, at least $5 is the minimum,
okay.
while basically give them time to process your application so that you're not waiting. And if you decline the forbearance, you have to do that with your servicer, and then they'll have you pay the standard monthly payment for that month, and then they'll update it for the next month.
Okay. That's a lot. There's a lot
Yeah.
going on in there. What was that website that you said for the IDR that folks can go and
Studentaid.gov/IDR.
studentaid.gov/IDR? And the reason to look into an IDR is because you might potentially have lower monthly payments based on the income that you're earning.
That's the goal. An income-driven plan is, but it doesn't calculate that way for everybody. If you have a
Sure.
small amount of loans and a decent salary, your income-driven plan, even in the SAVE plan, could calculate much higher than the standard plan, for example. And some people actually choose to do that to get out of debt quicker. But
Right.
overall, the reason behind the income-driven plans is to bring that payment to a more manageable amount. And instead of having the calculation based on the total debt, the repayment term, and the interest rate, it's based completely on the family size and your income.
Hmm.
So that's what's calculating it.
Gotcha. And when we think about these longer terms versus shorter terms, I would imagine it's like any kind of payment where for a longer term, you are paying more in interest, but your monthly payments are lower, whereas a shorter term, your monthly payments are higher, but there's less interest over time. Does that sound right?
Exactly. Yeah, exactly. And so we kind of work through in a lot of our guidance, we're working through both scenarios where it's like, okay, do you want to pay the smallest amount for 20 or 25 years? And overall, we'll look at what you could potentially pay in that circumstance. And maybe you will get some forgiveness in that, or maybe you work for a not-for-profit employer and can get forgiveness after 10 years.
Yeah.
That's a more ideal situation. Or can you manage the standard payments? Can you actually pay even extra and get out of debt for 10 years and save on interest?
Yeah.
So it all varies depending on what the goal of the borrower is.
Very much personalized circumstances. And,
Totally.
I would imagine, you and other folks on our finance team are fielding questions just constantly from families, and they're all, I would imagine, fairly similar, but also quite different depending on circumstance. What are the things that people are tending to ask most commonly? What are the questions that are popping up the most frequently in these conversations?
Yeah, I feel like a lot of times when we talk loans, it can vary so much, but lately there's been some common themes for sure. A lot of it is, I heard about the SAVE plan because the Department of Education has been sending weekly emails about the SAVE plan because they want to promote this as, the win where they, couldn't get the debt relief, but they can offer this lower monthly payment.
Yeah.
So they've been promoting the heck out of the SAVE plan, which has been, unfortunate in some circumstances because most people who were using an income driven plan in the past didn't have to recertify now,
Mm,
but the notifications kind of make it look like that. So we've had
yeah.
people who have recertified where their payments were actually lower before, and because their income was much lower 3 years ago, that type of thing. So there's some nuances there that we're able to help borrowers think through. But the common themes are really kind of what I stated before. Do you want to pay the lowest amount for a long time, or even just temporarily, just because, the cost of living is so expensive right now, and most people have not been thinking about their student loans for the past 3.5 years. So it's a shock for a lot of people to have to go back into repayment, or repayment for the first time ever. So some of it is, maybe I should use a low payment for this first year and then, thinking of a new strategy going forward. Or I've also had others in the complete opposite, where student loans are very stressful to a lot of people and they want to get rid of it as soon as possible. So I was
Yeah.
talking to someone just the other day where they're like, I think I can pay like $2,000 a month. And we figured it out, and we're like, okay, you could pay this off in 2 years. And overall, he was only going to pay like $1,000 in interest on the
Wow.
loans. So that
Wow.
was kind of one of the best case scenarios I've ever had. But they
Still
kind of
sounds
vary a little.
painful to me, right? $2,000
Totally.
a month, like you're getting
Yeah.
over it quickly, but man, that's a lot.
Yeah. That's
So,
a
you
shock to
know,
the budget for a bit.
that's right. Think about how that's going to affect you. Maybe you're having PB&J for every meal for a couple of years, but it could be worth it coming out on the other side.
Yeah.
You've mentioned the SAVE plan a couple of times, and I'm not a college finance nerd, so this is something that's a little bit more new to me and might be new to our listeners.
Sure.
So, who does this SAVE plan best fit? Who are the folks that should be thinking about that? I think it's an important initiative.
Yeah. So I'll try to quickly explain how it works. So basically,
Sure.
with the SAVE plan, they take an amount of income that is not counted towards the calculation. So it's 225% over the poverty guideline in your state based on your family size.
Okay.
So that alone, for someone that makes slightly under, so a single person that doesn't have any dependents, if they earn less than 34, little under 34,000, that calculates at a zero monthly payment just based on that portion of the calculation alone. And if
Okay.
you make more than that, so yeah, if you make more than that, what they do is they take the difference between your income and that, and they take 10% of the what they call a discretionary income.
Okay.
And then that 10% is a certain amount, and then that's divided by 12 for the monthly payments for that
Okay.
year.
Okay.
So, um, in general, we used to always say that income driven plans would work most only if your income was less than your overall debt. And because of the changes in the SAVE plan, that's not really a good rule of thumb anymore. You can earn quite a bit more than your total loan debt, and still benefit from this, especially if you have multiple dependents. But um, in general, it's really for someone that is looking to potentially reduce their payment, whether it's permanently and they want to take advantage of the 20 or 25 years forgiveness that brings after that point, or if it's a temporary a reduction in payment while you figure things out.
And we had a fairly full discussion about the SAVE plan about a month ago. Sally was the host that aired on
Right.
August 31st. And Jennifer Wilcox was on talking about that. So if you want to learn more about the details of that plan, you can go into our archives and pull out that episode. All right, we've got about 30 seconds. Big question, Michelle. What's the best way to get out of student loan debt quickly? 30 seconds.
You stay on the standard plan and pay extra towards principal. For example, if you have $30,000 in debt, a $300 roughly monthly payment, if you pay double that, you'll be out of debt in under 5 years. Okay. So, and you would save more than half of the interest. So just
pay
one
more
example.
faster.
Yeah, pay more. Yeah.
Great. It's complicated, Michelle. I don't even know how you all keep this straight in your heads, but it's remarkable. And really delighted to have you as a part of our team. Thanks a lot for coming on the show.
Thanks for having me.
Of course, folks, when we come back, we're going to talk about that other big SCOTUS decision in higher education, the decision on race-conscious admissions. Don't go away. We'll be right back.